Welcome to Yahoo Finance Live. I'm Julie Hyman, along with Josh Lipton. We're here at the New York Stock Exchange, and here is what you need to know at 3 p.m. Eastern. Investors waiting on a key announcement from the Treasury Department on how much the government needs to borrow for the months ahead. The results could overshadow the Fed decision on Wednesday. We'll explain why and what it means for you and for the market.
And it took 6 weeks, but the UAW strike against the big three automakers coming to an end. The union reaching a deal with General Motors today after expanding the strike over the weekend. Later in the show, we'll look at the rise of the American worker, especially as pharmacy workers kick off a 3-day walkout today.
Plus, Alphabet CEO Sundar Pichai taking the stand in the government's antitrust case against the tech giant. He defended the company's deals to have Google be the default search engine on many devices and browsers. What his testimony means for the case later this hour. Let's get you up to speed on the market action, though, first. And we've got green across the board for the major averages. Really a bounce back here after the selling that we saw last week for the major averages. The S&P and the Nasdaq each up about 1.25%, 1.33%. The Dow leading gains, say 1.75%, or about 562 points is the gain right now. Communication services, consumer staples, financials, tech, all of them are higher today. The only group within the S&P that is in the red, very slightly so, is energy.
And the Treasury Department just announcing it will need to borrow more than $1.59 trillion this quarter and in the first quarter of next year. On Wednesday, it will unveil the new borrowing plan to help pay the U.S. deficit, mapping out what the sale of bonds will look like in the next quarter. News will be coming just hours before the Fed decision, where the central bank is expected to hold rates steady. So this is important, Julie, because yes, we have this week the Fed policy statement we know on Wednesday. A lot of expectations there. They're going to stay on hold. But this now is the U.S. Treasury announcing, hey, here's our financing plans to fund what this budget deficit, which we know is worsening. So basically the Treasury's new borrowing plan.
Right. So we've just learned in the past few moments that the Treasury says it is going to borrow another $776 billion in the fourth quarter after borrowing more than $1 trillion in the third quarter, as you talked about. That estimate for the fourth quarter is actually lower than the Treasury's prior estimate. So it needs to borrow a little bit less money, $76 billion, well, a little by government terms, $76 billion less than the previous estimate here. And then there's the implications for the Treasury market. That's what we're going to hear more about on Wednesday. So not just how much money the government intends to borrow or estimates it's going to need to borrow, but how is it going to borrow it? In other words, how many treasuries is it going to sell? What are the durations of those treasuries and how much for each duration? In other words, what is the supply that's going to be coming to the Treasury market?
And when you look at the composition, there is some disagreement on the street about what that's going to look like exactly here for this debt issuance. Per Bloomberg, the JP Morgan Chase rate team, for example, is looking for rinse repeat of August, right? No change there in composition. But they seem to be kind of an outlier because others, Wells Fargo, Goldman, Barclays, Morgan Stanley, expecting the Treasury to tilt, they say this time more towards short-term securities, in part given what we're seeing in long-term rates.
And just a quick gander on the Yahoo Finance Interactive right now to take a look at what we're seeing in the Treasury futures market as a result of what we just got a moment ago. Sorry, I'm just clicking around here a little bit blindly because it's not populating on the right side. We'll get back to this. The point is, we have been seeing yields push higher today. We've been seeing prices push a little bit lower today. It doesn't look like that this announcement we just got changed that at all. But one of the things that has been weighing on the Treasury market has been this enormous supply and the U.S. government deficits that need to be funded. So like any asset, you have a supply-demand equation. And as the Treasury has been issuing record amounts of debt, that has put pressure on prices and pushed yields higher because, for folks who are not aware, the yields and prices move inversely when we're talking about treasuries.
Yeah, that debt issuance has been an issue in the prices. It's interesting. This is one moment, and it'll be interesting how we spin ahead now to the Fed policy statement as well on Wednesday, and we see there it seems like the economists and the strategists, the investors have been talking to, Julie, have all been kind of singing from the same song, everybody expecting a pause at that point.
A pause at that point. December might still be a live meeting depending on the data that we get between now and then. But yes, it seems like that is the broad expectation. By the way, one other thing to mention here is that many investors are closely watching the Bank of Japan, and there was It's expected to make a decision overnight on rates. There was a leak to Nikkei, which reported today the Bank of Japan may be willing to loosen its yield curve control to some extent, which means putting upward pressure on yields. So we'll see if we get any sort of commentary to that effect here in the United States as well, even with the pause. Recent economic uncertainty, geopolitical tensions, the recent sell-off have some investors considering increasing their allocation to bonds. And with the Treasury Department's upcoming plans for the next quarter's bond issuance, there's a lot to keep in mind for your portfolio. For more on this, we turn to John Buckingham, Kovitz Principal and Portfolio Manager. John, thanks so much for being here. We were just talking about all of this issuance we were seeing in the bond market and the pressure that's been putting on prices. How are you thinking about allocation and or the impact on stocks from these higher bond yields?
Right. Well, I am an equity guy, so naturally I'm going to still be very optimistic about the prospects for stocks. We have to keep in mind that while interest rates have risen dramatically, believe it or not, they're still relatively low versus where they have been long term. Our investment newsletter, The Prudent Speculator, started in 1977. The average yield for the 10-year Treasury has been about 5.84% during that time. So I get that yields are much higher and we got to get used to that. But valuations on stocks, especially the average stock, we have to keep in mind that the overall market has not done well. In fact, is down significantly this year, the average stock, whereas, say, the S&P 500, the Magnificent Seven, if you want to call them that, the S&P 500, of course, is still higher. So there's lots of opportunities for longer-term oriented investors to take advantage of some of the big sell-offs we've seen here in reaction to earnings, especially the Q3 results that, generally speaking, have been very good. But, of course, guidance is always the key, and many companies have not been as upbeat as they might have been in the past.
And John, another, of course, big data point for investors this week will be that Fed policy meeting on Wednesday. I was just talking to Julie about that. The economists, the strategists, the investors we have on, John, they expect the Fed to stay on hold here, to pause. Is that your expectation, John? And just as importantly, when do you think you would expect them to start cutting?
Right. Well, I'm not an economist and I don't play one on TV, but I will say that the consensus is that the Fed is done and that there will likely be rate cuts starting in 2024. The problem, if you will, for the Fed is that the economy has been so gosh darn strong, with that GDP print last week. So the economy has held up far better than the Fed might have envisioned. But of course, Fed, the rate hikes we've seen, that works with a lag. So ultimately, we do think there will be, a hit to the economy. We don't think that we will have a severe recession. We'd be in the camp that if there is a recession, it'd be relatively mild. But personally, my view is that many stocks have already discounted a severe recession. So if we do get a modest economic slowdown, I think that equities can make some headway as we head into the new year. And the other point I'll make is that historically speaking anyway, stocks have done well in higher interest rate environments. Stocks have done well in inflationary environments. Well, heck, stocks have done well no matter what the backdrop is. Unfortunately, in the near term, obviously, there can be some volatility, as we've certainly seen here of late.
We have indeed. And yes, stocks over the long term, of course, they do indeed go up. I'm looking, though, at some of the stocks that you like right now. And as a value guy, some of these names, I got to be honest, surprise me, right? If I'm looking at some of the big cap tech names that are on your list, Alphabet, Microsoft, Meta, some of those kinds of names, because those are indeed the ones that you would allude to when you're talking about recent volatility based on the back of higher rates. Are these guys value stocks right now?
Well, we still think they are. Of course, we bought them many, many moons ago at much lower PE ratios than where they're trading today. But again, as a value investor, we're trying to look at where companies we think where they should trade in the fullness of time versus where they are trading today. And keep in mind that names like Microsoft, Meta, Alphabet, Apple, all of these companies have fantastic balance sheets loaded with cash. So higher interest rates from a business perspective, generally speaking, are a positive, not a negative. for their overall financial structure. Obviously, higher rates can impact consumers, and that could impact the business and profitability ultimately. But we still think there is value in those names. Now, again, we're selective. Do I think there's value in Tesla? No, I don't think there's value in Tesla. In other names like an Amazon, which I see you have up on your screen, we don't own Amazon. We think it's still a little too expensive. But the Metas, the Apples, the Microsofts, and the Alphabets are names that we do own. But again, when we look at our portfolios, our forward PE ratio in our newsletter portfolio is below 12. And we think that's very attractive. And again, we are a value shop, and our metrics on our stocks are actually cheaper than the value indexes, and our dividend yields overall are higher than the value indexes.
And John, I want to switch gears here to talk about geopolitical risk a bit, specifically the Israel-Hamas war. John, I was just two questions for you. One, are you surprised at how relatively calm the oil market has been in response to this conflict? And two, John, how do you think investors should think about this risk, both short-term and long-term?
Well, it certainly does throw additional uncertainty onto the heap. We already have a lot of uncertainty, and this isn't the only conflict going on. We can't forget that Russia-Ukraine is still dragging on as well. So this is a very strategic part of the world. The concern, of course, is that it escalates more than it already has. And you are right. The price of oil, one might think, would be a little higher if people thought that we were going to see a severe escalation in that. So from my perspective as an investor, as you're looking to put money to work today, I think energy stocks are a good place to be. Again, I know they're getting whacked today, as you have the graphic there. The price of oil has come down considerably. But names like EOG Resources, Exxon, a company called Total Energy, out of France. There's lots of opportunity, I think, in energy, and investors should be going in that direction. Now, conversely, we see today and here recently, companies that are in the EV space. I mentioned Tesla. We're not fans of Tesla, but we do like a lithium producer called Albemarle. Now, it's been extraordinarily volatile, and we've taken money off the table when the stock was above 200 and bought it when it was in the double digits, but it's approaching double digits today. So if you like the EV space, there are ways to play that with inexpensively priced stocks like an Albemarle, ticker symbol's ALB there.
John Buckingham, thank you so much for joining us today, John, and for those stock picks.
Thank you.
And moving on, shares of Western Digital rising today nicely after the company announced it will split its disk drive and flash segments into two different businesses. CEO saying the separation will, quote, unlock significant value for Western Digital shareholders. So we did get Q1 results and forecasts here, Julie, but the big news is they're going to split into two separate publicly traded companies. We got, this is after talks to merge with Kioxia, which we were talking about in the last few days. That fell through. So spin off the flash business, that's memory for computers, portable devices, portable drives, and then the HDD business, which focuses on memory to the cloud data centers, sounds like. Splits planned for second half of 2024. Shares had slipped pretty hard, remember, because investors were kind of unsure what exactly was going to happen with Kioxia, but now we've got the news, maybe some relief about that news and the plan. Second option here apparently has some fans, and the CEO saying spinning off the flash business is the best executable alternative at this time.
Or Plan B, in other words. I saw it quoted as Plan B as well. Now, the company's been the subject of activist pressure from Elliott Investment Management because, as you said, the stock has not been doing great. And I think Elliott's been involved going back to 2022. I was just looking at a long-term stock chart. This company made its all-time high back in 2014 and has not reattained that since then. That record high, by the way, was around $110 a share.
Wow. Yeah, look at that
Then
chart.
the more near-term peak in 2021, when everything else was going crazy, was like in the 70s. So it's just quite interesting here that this stock has sort of been floundering, as I think we talked about the other day when we talked about this one. It's subject to commodity cycles, when you're talking about these disk drives, when you're talking about flash memory. And so we have seen it be sort of a very cyclical stock, and we'll see what it looks like as it now splits up and see if it does unlock any value. We shall see.
We shall see.
All right, we're also taking a look, speaking of cyclical sectors, on semiconductor shares sinking today on weak fourth quarter guidance. The CEO pointing to market softness in the company's release, and executives also pointing to weakness in auto demand because onsemi does make semiconductors for that sector, among others. Analysts pretty, mixed on this. One analyst over at William Blair saying that the outlook missed across the board, and other analysts saying, looking backward, this past quarter was decent, was solid, but the outlook is indeed quite disappointing.
Yeah, that seems to be what they're going through right now. The stock's just getting hammered if you see that drop. The results, I think, the street felt like were solid, but it was that outlook that was the issue. Truist, for example, which has a buy target at $122, says they think the weakness is coming from the industrial end market, which they know is consistent with what other semis have been reporting this earnings season. They said it should not be a significant surprise to investors, but apparently, judging by that reaction, it is to some.
Yeah, and the 5-year chart looks impressive for onsemi. I'm just looking at the SOX, the Philadelphia Semiconductor Index, year to date, and I think that ON is firmly meh when it comes to, it's up something like 6-7% year to date, exactly, which is like really very middle of the road here. So it's just been, it's underperformed the broader group, most definitely.
A rough day today.
Yeah.
And finally, here, ticket shares of Tesla trading lower in today's trade. That's after its EV battery producer Panasonic Holdings cut its automated battery production in September quarter. Company pointing to soft demand for EVs amid a global slowdown in the market. So you can see Tesla really taking it on the chin there. Now, that was one data point. I did see other reports saying they also were looking actually at ON Semiconductor. Right. That was another one. And that disappointing forecast, they're an automotive chip maker, right? And so some were saying, well, underwhelming guidance, maybe that's bad news. You saw that dragging down some names, Tesla, Rivian, to name a couple.
Yeah, and Panasonic in particular was talking about this slumping demand for higher-end Tesla cars. That's something we've kind of heard from Tesla itself. It reminds me a little bit of when we look at Apple and then we start to gather sort of the tea leaves from all of the Apple suppliers to, even if we've heard some of the leaks or the commentary from Apple itself, it then sort of is self-reinforcing when you get some of the suppliers to make similar comments. So even though we've heard some of this from Tesla already, it sort of makes investors sit up and take notice again to get this kind of a reminder that one of its suppliers is saying this.
We've been talking, too, a lot of the headlines we're getting recently about EVs have not been so great. Remember Ford deferring billions in EV-related investments. That caught people thinking. In other words, people are focusing on, yes, the EV market is growing, but how strongly is it growing, right?
And then do you have sort of a plateauing or a stalling out, to use an auto analogy?
Exactly right. Higher borrowing costs not helping there.
Yes, definitely not. All right, we're just getting started here on Yahoo Finance Live. Tech on deck. The government's big case against Google and its dominance in the search engine market. We'll break it all down with a law professor. Plus, earnings season rolls on. We'll preview results from Apple and tell you what you need to know ahead of the company's fourth quarter report on Thursday. Also, after the bell, we'll bring you earnings from image sharing and social media site Pinterest. All that and more when Yahoo Finance returns.
2023 rocked the markets.
NVIDIA, the stock has been on a tear.
Silicon Valley Bank's collapse is the second largest bank failure in the U.S.
Inflation,
mortgage rates,
the diabetes drug, Ozempic.
Now it's time to make bold decisions. Yahoo Finance Invest, the marquee event for investors seeking big ideas and bold decisions. Guided by the newsroom you trust. Don't miss it, November 7th, exclusively on Yahoo Finance.
Tech in the hot seat. Google CEO Sundar Pichai testifying today in the government's antitrust lawsuit against the search engine. The Justice Department alleges Google broke antitrust laws to keep its search engine dominant in the space, while Google says its success comes from having a good product. Pichai testifying today, Google faced a, quote, very competitive dynamic when specifically trying to get a deal with Apple. The implications of the trial are massive as the government tries to rein in big tech. For more on this, we turn to Harry First, professor of law at NYU. So, Harry, thank you so much for joining us. Let me start, Harry, by Sundar Pichai taking the stand today. What's his mission there, Harry? What is he trying to accomplish with that testimony?
Well, I think, first of all, the overall story that Google's trying to tell is that this is a fabulous company. It succeeds on its merits. Consumers love it. It gives them a great product. And hey, we've done nothing wrong. We've won fair and square. So that's the first thing. And then, of course, there are all the particular issues of the trial, which is, who are their competitors? Why does he think they're in a very competitive environment? Ultimately, why did they pay so much money for the default status? What does that mean? So those are all things to address as well.
Harry, it's Julie here. Let's take that last bit for a moment and linger there,
right.
Because indeed, that's a big number that we learned about last week. $26 billion that the company paid in 2021 to be the default on mobile phones. What does that do to Google's argument, that big number?
Big to you, small to them. I don't know. It's
Right.
right. Yeah, I don't have that many zeros in my pocket, but they apparently do. So this is a number that's hard to explain. What exactly are they buying? And I don't think they necessarily want to explain that. They pay a lot for customer acquisition, as it's called, and this is part of it. And it's a competitive race. They say that, they compete with other companies for this position of default. And, others can try to bid for it as well. So it's not so much that they can explain why it's so valuable. It's why it doesn't exclude others. And why that shouldn't be, so predominant a fact.
And Harry, what do you, bottom line, though, just make of Google's defense? I mean, Google will say we are big and powerful, and the reason we're so big and popular is because we make a product that a lot of people like. And if you don't like it as a consumer, by all means, switch to a different search engine. You find that convincing?
Just a click away, right? Yes. Well, I'm not sure about the argument, but I think I'll Google it. So that was a joke, by the way. I don't think they want to make an argument that we're big. I think they want to make an argument that we're right scaled, and that we, because of our efforts and because of our algorithms, it's not so much our size, but the money we invest in our algorithms and giving search results fast and full and accurate. This is what consumers want. And after all, you might say, and courts do say, antitrust is a consumer welfare prescription. It's about benefiting consumers. And consumers have voted with their clicks. So as they would like to say, although people deride this argument to some extent, competition is just a click away. They can always, go to Bing, go to DuckDuckGo. And why don't they do it? Because Google's better.
I DuckDuckGo all the time. No, I.
Me too. I agree. I agree.
But just to take a step back for a second, I mean, you've been in the antitrust game for a long time, and so I'm curious how you situate this case in the broader trend that we have seen of this Department of Justice being relatively assertive when it comes to these kinds of cases, but they've really had a mixed record. How important is that? How important is this case for them to win?
So it's pretty important. So if to put it in the context that you did, the Justice Department took a 20-year nap in going after dominant firms and in going after tech firms. So it was in the last century, the last millennium, when they filed the case against Microsoft in May of 1998. So it took 20 years before another case was filed. And that was a time when these big tech platforms that we know have come to dominate U.S. economy, that's the time they were growing. And they basically grew without drawing any antitrust fire. So that time has ended, at least in terms of bringing cases, because there are now cases pending against Google, against, in some way against Microsoft, but against Facebook, against Amazon. And, the cases are now being litigated. But we have to see yet what the results will be, so that we don't know. But that's why it's important, of course, as you indicated, really, for the government to win these cases, not just to bring it. And bringing them and losing the cases, well, it might tell us that we need some changes in the law, but I think from a government enforcement point of view, they'd rather find out that the law was suitable and was there and could be used. So, that's yet to be seen.
Yeah, especially given maybe some of the difficulties in changing laws in this current moment. Harry, first, once we get that verdict, we'll have to have you back to react to it. Thank you so much. Appreciate your time today.
Thank you. Glad to talk to you.
Well, President Biden just signing an executive order taking aim at artificial intelligence with the goal to protect consumers and workers. The order builds on previous commitments from AI companies and does represent the first major binding government action on AI in the United States, at least. We've had them elsewhere. Joining us now, Sinan Aral, MIT professor of management, marketing, IT, and data science. And Sinan, it's been a while since we've talked. It is a pleasure to see you again. And especially on this topic, which is an important one. Yeah, thanks. So this is an interesting executive order. Do you think, first of all, just give us big picture, whether you think it's done a good job?
Well, I'll say this. In the absence of any ability to have congressional action, the difficulty of bipartisan supported congressional action, this is big, it's bold, it's broad. It has a number of provisions. It has provisions for safety, for privacy, for equity, for workers, for competition and innovation, and leadership abroad. And it really targets those foundation models, the big AI companies, in terms of their safety and security standards.
And Sinan, there are companies, at least, relatively more big, well-established ones who've been asking to be regulated. How do you think companies, public and private, are going to respond to this? Will they be enthusiastic?
Well, I got to tell you, it depends on where they sit. So when it comes to the safety provisions, the executive order directs NIST, the National Institute for Standards and Technology, to develop safety, security, and even red teaming standards for these foundation AI models. Red teams are those teams that search for vulnerabilities and exploits. And so these companies must report testing on their training to the government before bringing any of these new models public. It also affects biosynthesis. It creates biosynthesis screening as a requirement for federal funding and reporting. And it also is setting standards for detecting AI content and watermarking it as being from AI. So this is going to affect biotech and pharmaceutical companies that use AI. This is going to affect foundational AI companies like Google, Microsoft, OpenAI. It's going to affect anyone using AI to create content that is going out on social media or anywhere else on the internet. In that way, it's going to affect a lot of companies. There's also provisions for privacy, a big call and leaning on Congress to pass bipartisan federal privacy and data protection legislation. Depending on how that turns out, it could affect every company that holds data on any kind of individual. It also provides money for privacy preserving technologies like differential privacy or cryptography. That could be a boon to companies in those spaces that are developing privacy preserving technologies. It also strengthens the guidelines for how the federal government collects data, which could affect everyone all the way down to the IRS, as well as the census, with regard to collecting personally identifiable information. As we know, as of 2020, the census started using differential privacy in how it collects and stores data.
So in other words, it is big, it is broad, it is ambitious, is my takeaway from all of that. Sanan, to just take one of those things that you mentioned, the watermarking piece, that speaks to another area of your expertise, which is misinformation, right? How is this going to affect the credibility of what we consume online? Is it going to improve it because of watermarking? And how enforceable is that piece?
Well, I have to tell you, it's absolutely necessary, difficult in practice to put into practice. So if you go backwards from the present day, we have the war in Israel, between Israel and Palestine. We have the Ukrainian war. We have COVID before that. Misinformation has played a role in each of these geopolitical events with dramatic consequences. The idea of being able to separate what is real from what is fake is important to how we form our opinions, how we advocate for different government policies, how the governments react in these situations. Doing it in practice and ensuring that it's done everywhere is another story. I think that is a very difficult thing to enforce, although as it relates to watermarking government-related content, when people see that there is no watermark, they could rightfully perhaps observe that it's not official communications and therefore be able to detect some things. I also think, by the way, Julie, that it's worth talking about a little bit the equity and innovation competition standards, because, for example, in the equity standards, it is directing training and assistance to prosecute AI civil rights violations. It is also setting standards in criminal justice, that's sentencing, parole decisions, pretrial detention, surveillance, crime forecasting, predictive policing. This is going to affect many industries that are involved in criminal justice, as well as, I have to say, it's really important to see buried at the bottom a nod to, quote, encourage the FTC to exercise their authority. That probably means merger oversight and other actions or complaints to ensure competition. That could be big in terms of startups being bought. It could be big in terms of mergers being proposed. It could be big in terms of antitrust cases. And it also establishes another nod to increase the amount of study and work visas for AI-related education and work. That could affect immigration on high-tech related domains.
Sanan Aral, thank you so much for your time and insight today. We appreciate it.
Thank you.
And coming up, we're going to break down the day's market action and tell you why you need to watch the bond market this week. Markets in rally mode, the buying picking up here as we head into the close. Jared Blickery is here on the floor of the New York Stock Exchange with more. Jared.
Hey there, Josh. I was looking at the market this morning on the open and we were in rally mode. I was saying, is this a dead cat bounce? We'll have to see. This is actually some nice strength into the close today, so remains to be seen, although we did see that huge breakdown last week. Let me just go to the Wi-Fi Interactive where we can chart the day's price action, and it is a Dow that is on top today. That's up 1.75%. Small caps are lagging, but the S&P and Nasdaq each up more than a quarter, 1 1/3% actually. If we take a look at the sector action, we can see all 11 sectors in the green, led by communication services. Then we have financials and consumer staples and industrials, all of those outperforming. Just taking a look at the Nasdaq itself, Amazon up 4%. That is in consumer discretionary. It is Alphabet and Meta that are in communication services, which is in the lead. Also notable is Tesla taking a hit for 4.5%, and we got some other red squares. Looks like some China stocks like Pinduoduo down 3.5%. I want to take a look at the bond market, though, which usually closes at 3 p.m. I'm going to go to the 2-year Treasury note futures, which are trading after 3 p.m. so we can see something, the bond market reaction to an announcement that was made that has to do with the amount of treasuries that are going to be issued over the next quarter. Now you can see there's a tiny little downtick here. That's in the futures price, and that means that yields ticked up a little bit. And basically that's because there was not too much of a surprise in the announcement. Now what we're looking at here, this is the U.S. Treasury borrowing estimates. We have Q3, which is in the rear view mirror, and then we have the current quarter, Q4, in purple. The news we just got is that there's a little bit less in terms of bond issuance that needs to be made than prior thought. And so maybe that's why we got that little bit of a reaction in the bond market. That is the opposite of what happened last quarter, 3 months ago, when we got that big revised uptick in issuance, and that led to a big surge in yields. Bottom line, we have a huge auction set on deck next week. I'm going to show you some estimates for this. This was done before the announcement today at 3 p.m., so they could be revised. But all in all, we're looking at $114 billion in Treasury issuance in the long end of the curve next week. So considering all of this, still got some fluctuations in the bond market, but it looks like a little bit of settling, not too much of a surprise in terms of the issuance, and that's actually a benefit for risk markets.
Yes, we shall see what happens after we get more details on Wednesday from both the Fed and from the Treasury. Appreciate it, Jared. Volatility taking a bit of a backseat on Wall Street as stocks soar heading into the close, but markets are gearing up for a big week as investors wait on the Fed decision. Our next guest says it might be time to consider broad hedges. In this week's Options Bit, we're joined now by Jim Struger, Kineo Capital Managing Partner. And, the VIX is down today, but it's not down that much, interestingly. It's still close to 20. Jim, I should say, fantastic to be reunited with you, first off. But secondly, what are we seeing in volatility right now? What does that tell you about the stability or lack thereof of any rallies we get here?
Well, as you mentioned, obviously a nice day for risk assets and equities today, but spot VIX still hovering around that 20 level after spending several months an awful lot lower than that. Our broad thoughts on volatility cycles are that we are and have been in a high volatility regime going back to the COVID-induced shock of 2020. So we're 3+ years into this, but that there is still an elevated structural floor under volatility. So today, nice for risk assets, nice for equities, but looking forward, we do think it makes an awful lot of sense to tighten up portfolios, take down risk, and consider adding some hedges.
And so what does that actually mean, Jim? Give us some examples. If you want to consider hedges, what would you suggest?
Right. So what we sort of drew up was just in the Qs. So the Qs is a tracker of the Nasdaq 100. And we're just thinking, looking out to year end, that it makes sense to put some protection on. And I think one of the tough places for many investors to start is understanding how to structure even a straightforward hedge like this. So what we've done is looked out to December 29th expiration, literally the very end of the year, and we want to put on a QQQ put spread. So to find and identify that first strike that we're going to be long, we're going to go out and we're going to find the 30 delta put. On many brokerage platforms, that'll look like 0.30. That's a 30 delta put. We want to buy that, and we want to turn around and sell about a 15 delta put. Now, we drew this up earlier today, so the prices will be a little bit different and the strikes might be a little bit different, but that's a 310 strike put in the queue. So what that looks like when you put it together is a 330, 310 put spread. Earlier this morning, that cost about $3.50. And what that would do for an investor, especially someone who's very long big cap tech, which is pretty much everyone, is create a 4.7 to 1 potential payoff for that put spread hedge.
And I'm just curious, are you seeing a lot of other options hedging activity like this right now?
Well, we manage capital for clients, so we're not sitting on the sell side handling orders all day long. I think, though, that obviously this market has broken down through some significant technical levels, so our clients have certainly wanted to have more conversations about how we see the world closing out 2023 and heading into 2024. So from our perch, there's no question that there's more concern than we saw earlier this year about actively managing risk in portfolios.
And Jim, let's talk specific tickers here as well. Apple event tonight, Jim, 5 p.m. local time out there. Also, of course, reporting earnings later this week. Any specific trades that you see there, Jim, that you would consider?
Sure. So Apple reports after the close on Thursday. There's about a 4.3% implied move. That's what the option market is telling us. Over the long course of time, Apple tends to move about 4.6% in absolute terms following earnings. But over the last 8 quarters or so, it's only moved about 1.1%. So we feel like it should be moving a lot. The reality is it really hasn't. The way we would structure a position into earnings for a name like Apple is via an iron condor. And what an iron condor consists of is selling a call spread and selling a put spread. You can see the P&L that you've put up right now. So the position that we're structuring for, the outcome we're structuring for, is for the stock to move very little after earnings. So specifically, the way we would structure that is using Friday's expiration. And again, we priced this up earlier today, so prices might be a little bit different. But it's a 157.5, 162.5 put spread against a 177.5, 182.5 call spread. So again, you're selling the inner strikes, you're buying the outer strikes. The most that you can make on this trade is what you bring in by setting up that position. And the expectation you're playing for, again, is that Apple, following earnings, would move very little. You'll know very quickly because this is we're using Friday's expiration here, and they report Thursday after the close. So it's basically a position that Friday morning we'll know the outcome. But that's how we would think about that, really taking advantage of pumped up implied volatility and selling that to the people that believe that Apple could move very sharply, either up or down.
Thank you, Jim Struger, in this edition of the Options Pit, sponsored by Tasty Trade. Thanks, Jim.
Thanks very much. Thanks for having me.
And coming up, more Yahoo Finance after this.
Goldman Sachs analysts and top executives from across the technology, media, and telecoms landscape are gathered in San Francisco for its annual Communacopia and Technology Conference.
Nextdoor is doing some pretty cool things on the AI front with our assistant and also with Vitality. For us, it actually starts to unleash unique data. We are the local knowledge graph, so I think the value of what we do starts to really shine forth. We're the only platform where you're finding out what's going on around you locally in real time. So with that data, we can do things like on the platform, help a neighbor compose a post in a way that is more engaging. So the assistant or the AI actually does that for you.
There's lots of interesting discussion we can have around AI. So we announced just this morning Zoom AI Companion, which is our answer to how generative AI is going to be included in our platform. And there's all kinds of really cool features that come with that for our paid subscribers. There are things like Chat Compose, if you're in a chat thread and you want to be able to respond to that. There are things like meeting summaries, which after the fact help categorize and capture not only what happened in the meeting, but also the true sentiment.
I think any creative would admit that AI is transformative to how they think about and how they concept new ideas. So I think it's going to be very exciting. It's still early innings, and we got to figure out how to do it right.
There's a lot of hype in our industry. I think this may be underhyped. I think it impacts things at so many levels. It impacts how we interact with computers and how they seem personal. It generates how art and media is created. It's really a breakthrough in computer science, and it impacts not only the products, but it impacts how software is created.
There certainly needs to be a lot of debate about AI and journalism. 57% of newsroom jobs in the United States have been lost. We're facing another wave, in this case a tsunami potentially of job losses because of the impact of AI. And these are not just jobs lost, but it's insight lost. It's important that all media companies understand the impact, but it's incumbent on the big AI players to understand their impact.
We launched Intuit Assist. And Intuit Assist is really a personalized, intelligent assistant in your pocket. It's also powered by AI-driven human experts so that when you are getting assistance from Intuit Assist, if you ever need to talk to an expert, no matter what it is that you're doing, you're able to do that. So there's always a gateway to help.
AI is going to change this whole industry completely. And so we're thinking a lot about how do we use AI to match people a lot better and to support the conversations that are happening. I think conversational AI is also a big opportunity because people do produce all these messages. So helping them craft those messages, make it easier to communicate, I think is something people will really appreciate as well.
Let's take a look at shares of BlackBerry right now. They are spiking on a report that CEO John Chen has reportedly resigned. The Globe and Mail saying he will exit on Friday, and more details will be revealed when the company makes the official announcement later today. So that is a strong move on that headline, up more than 7% right now. Obviously, you talk about the arc. I mean, John Chen has been there for a long time, and maybe we'll find out more, hopefully, from the company about what exactly is going on and next steps and who's going to take that big seat in the C-suite. But it just is a point to remind yourself about the arc of the company as well. I mean, BlackBerry was an absolute powerhouse in the world of smartphones. It's almost like it wasn't that long ago, but it's hard to even remember. But I mean, it's bread and butter. Yeah. It was business. It was government.
Do you remember when Obama didn't want to surrender his BlackBerry?
Well, Obama was a fan. I mean, it's so popular they had their own nickname, Crackberries. That's how popular. Right. Yeah, that's how popular. But it was the keyboard. It was the security, and at one point that company had tens of millions of active users.
And then at a certain point, it became not a hardware company anymore, but sort of an IP company, right? A technology company, a software company, effectively. Yep. Most recently, earlier this month, the company said it had been doing a strategic review, and then it said it was going to IPO its Internet of Things unit and was trying to sell its patent portfolio, which has long been viewed as the valuable part of the business, but no news came that it was then going to be sold. So maybe that draws into question, is it the valuable part of the business? And I was just looking at the stock price. First of all, it's down some 50% since Chen became the CEO back in November of 2013. That's thing one. Thing two, even after it made that announcement about the spin out earlier this month, it has only been up 5 days, 5 trading days in the month of October. So, it's sold off some 35% or so since the beginning of September.
BlackBerry got in part crushed by competition, right? I mean, that's what happened to this. Steve Jobs comes out in 2007, and the touchscreen revolution started, and BlackBerry just wasn't there. So to your point, they pivot. They do this hard pivot, enterprise security software, automotive software, but there is, of course, plenty of competition there as well.
And again, this is according to the Canadian paper, the Globe and Mail, because BlackBerry is a Toronto-based company. They're saying that Chen is going to exit Friday, which is soon.
Very
obviously.
soon, yeah.
So we have not heard anything directly from the company as of yet. I don't believe confirming whether indeed this is the case, but he has really been
the face of that company.
The face of the company for the past decade.
I am impressed by, again, we have to wait for the companies who they see. That timeline sounds very quick, though. I mean, this Friday, it'll be interesting just to hear from the company what are the reasons for that, and then who is in the lineup there? Who's the lieutenant? Who's going to come over and take that seat?
And especially since it's a business that is going to spin part of it off and try and sell the rest. So it's just a caretaker, I guess, in the interim. That's what it kind of seems like here. So we'll see what ends up happening.
All right, we'll see. Well, hopefully more news from the company. We'll see. Coming up, the closing bell on Wall Street. We'll be checking out on the latest market moves and the top trending tickers. Stay tuned.
was the closing bell on Wall Street here. Let's do a quick check of the markets on this rebound Monday. All three major averages finishing the day in the green and near the highs of the session. The Dow leading the charge here, up some 511 points, so it's about 1.5%. The SP and the Nasdaq up about 1.2% each. Let's take a quick look at the Wi-Fi Interactive at some of the action throughout the course of the day. Just taking a look at the S&P 500 here to start, and as I said, finishing near the highs of the session here on this day. But if we look past or over the past 7 days, you see here why I call today a rebound, right? We saw a slump in the major averages last week, so bouncing back from that a bit today. As our Jared Blickery pointed out earlier, really seeing a broad-based rally during the session as well. Communication services leading, followed by financials and consumer staples, but not really any kind of theme here in terms of cyclical versus defensive, et cetera. It was kind of a rising tide lifting all boats during the session. We've also been watching the Nasdaq 100, of course, and seeing a broad rally there, with the exception of Tesla. We talked about this a little bit earlier, that Panasonic out with some discussion of its big battery customer, i.e. Tesla, not showing as much demand. And so that putting some pressure on Tesla shares, as well as results out from ON Semiconductor, which indicated weakness within the automotive space in particular. Here's a quick gander at the semis, just going to equal weight them so you can see what was going on here over the course of the session. ON's not actually on here, but you see a lot of the other semiconductor makers under pressure, particularly NXPI here, NXP Semiconductors. So that was one of the areas of red. But Josh, overall today saw a strong session.
All right, let's get to some tickers now. SoFi, let's start there, reporting better than expected third quarter earnings results. The company seeing a boost by the return of federal student loan payments. So this one's interesting, Julie. So raised revenue forecast for 2023, on track to reach net income profitability under generally accepted accounting principles by end of year. The stock did not do a whole lot today, though. You can see we only popped about 1%, though within the context that, listen, the stock has had a terrific run this year. It's up about 50%.
Yeah, and the revenue with that year-over-year gain in revenue of 27% impressive. The company also adding a record number of new members, 717,000. SoFi really has expanded its offerings, right? And in terms of the products that it gives to consumers, more of a fully rounded banking operation, if you will. It's interesting looking at SoFi, which also, of course, talked about a student lending overhang, that is starting to maybe roll off. When you look at the other fintech companies that are going to report, because there the setup has not been great, right?
It's horrible.
So if you look at a Block, for example, the stock is trading at a 3.5-year low.
It's down nearly 40%.
Going into its earnings this week.
Yeah, Block is a mess, down nearly 40% this year. PayPal, not a whole lot better, down about 30%. So those very rough moves for those, investors.
And not just down year to date, but I was looking at Block. Its all-time high was back in August 2021, and so many fintech stocks and tech stocks generally were flying high at that point. Block is down 85% from that record high in August 2021, and some of that is that Block, of course, became more closely associated with cryptocurrencies because of its investment in that area. Part of it is decisions it made. It bought Afterpay. Remember the one of those buy now, pay later companies? It bought it also in August of 2021. And so it's going to be really interesting to hear what that company and also what PayPal have to say this week, because you can take away sort of bigger consumer demand lessons from these earnings. But there's also some very idiosyncratic stuff to these two companies.
For sure.
Yeah, definitely interesting stuff. Let's talk about another mover, and that is AbbVie. Barclays upgrading the stock to overweight from equal weight. The firm noting the recent drop in the stock as an overreaction. The share's up about 2% today. Earlier, they were among the best performers in the S&P. Then they came back a little bit here. But the company did come out with its earnings last week and raised its profit outlook as well.
Yeah, so they hit earnings last week on Friday. Stock dropped on that, and that's where Barclays says, listen, we think that's an overreaction. We think that's too much, and they're moving in. They obviously see an opportunity there. So new plans, they raised the rating on the drug maker to overweight. They upgrade, they say, reflects clarity on the top line evolution over the next 12 to 18 months. They also, by the way, raised their price target to $170. So overreaction, but also they think they have better clarity into what's coming. down the pipe.
And we should mention Barclays Carter Gould, longtime veteran pharma analyst, so one who's pretty closely watched on the street.
And moving on here, let's get one last one here. Reality Income is going to acquire Spirit Realty Capital in an all-stock transaction. This deal is valued at approximately $9.3 billion. So this one, stock is down about more than 10% this year. The news here is Reality Income. So they own like convenience stores, Julie. They own warehouses. They agree to acquire Spirit Realty, all stock, expected to close Q1 24. And I guess the strategy here is let's diversify Realty Income's business, create $50 million in annualized synergies, according to the company, build a real estate investment trust.
You know, this is a sector that has been challenged, right? If you look at real estate investment trusts. And so it's interesting to see the stocks decline, you know, on the day that you announce a deal, or at least in the case of Realty Income. You also had another sizable deal in this industry in the healthcare REIT space with Healthpeak Properties buying Physicians Realty. And that is about a $2.6 billion deal. So coincidentally, two deals, same day, same space, in what has been kind of a challenged area, among many other reasons, because of higher rates.
We've got a very smart person to talk about this.
And we're going to do it right now. It was indeed a merger Monday when we talk about real estate investment trust. Not only is Realty Income set to acquire Spirit Realty Capital, but also Healthpeak Properties and Physicians Realty Trust disclosing an agreement to merge. Now, as these companies look to complete these deals, we're taking a look at the investment opportunity, or not, maybe, in the real estate investment trust environment. Here to discuss is Rich Hill, Cohen and Steers Head of Real Estate Strategy and Research. Rich, thanks so much for being here. This has been such a fascinating area. I mean, we talk on this show a lot about residential real estate, but obviously the REIT space, the broader REIT space has also been really interesting. What do these two deals tell you about the environment right now?
Sure. So maybe I can set the stage for you. Look, listed REITs are down around 33% from their peak, which was incidentally at the very end of 2021. Why are they down so much? Well, I think it comes down to a couple different factors. First of all, there's concerns about some aspects of commercial real estate, notably office. I would note that office is only around 3% of listed REIT market cap. Number two, there's been some concerns about the commercial real estate debt markets. Listed REITs have really strong balance sheets, and I can talk through that with you. And then number three, there's obviously been some debate if we're going into a recession or not and what that will do to cash flow. Believe it or not, net operating income growth for listed REITs is on really strong footing. We're in the midst of 3Q earnings right now, but in 2Q, they put up around 5% NOI growth, which is well above the historical average of around 2.5% or so. So I think you're leading off with a really interesting question. You know, why are listed REITs down so much? And if they're down so much, why are these transactions happening?
And Rich, I'm just interested, you know, we talk about REITs, a lot of different sectors there, Rich, I think you're suggesting. Where are you seeing opportunity in that space? You know, is it in housing? Is it in office, hotels? What do you find attractive right now, Rich?
Yeah, sure. It's one of the most fascinating questions that I get a lot. I think many people group listed REITs under one big umbrella of commercial real estate, but the reality is it's 18 different subsectors that sometimes behave quite differently. So some of the subsectors that have done quite well this year and we like are things like data centers. Why have data centers done so well? Well, they're benefiting, among other factors, from the AI boom. They don't have enough data center space right now, given all the investment that is occurring to take advantage and position for AI over the next coming years. Secondarily, you have things like single-family rentals. It's really hard to buy a home right now. So as a result, some people want to rent the so-called American dream. Single-family rentals are another place you can benefit from that. And the third point I would make to you is things like seniors housing. We have an aging baby boomer population that did not move into seniors housing during COVID, and now they are beginning to move back into seniors housing. So there's this huge wave of demand coming at a time that labor costs are coming down. So those are three sectors that I think we like. On the other hand, we're quite cautious on office. We continue to be cautious on office. But I would just tell you that it is a broad subsector that doesn't necessarily all behave the same way at the same time.
That being said, Rich, and while there are certainly different fundamentals in the different subsectors, there is one thing that I'm guessing affects them all, and that's rising rates, right? In an environment where if what you do is buy real estate as a company and own real estate, then your debt servicing costs maybe have gotten higher. So talk to me about that and how, or is that more perception than reality as well in terms of the broad effect on the industry?
Well, it's a little bit of both. So let's not beat around the bush here. Commercial real estate is inherently a levered asset class. So that means as interest rates rise, financing costs rise. And it is having an impact on commercial real estate, broadly speaking. We have a wave of forthcoming loan maturities over the next several years. And a lot of those loans that are maturing were financed with floating rate debt over the past several years. So I don't want to beat around the bush here again and say that there are no issues facing commercial real estate, the commercial real estate sector, because there are issues facing the commercial real estate sector. We just so happen to think that listed REITs are in a much, much better position than the broader commercial real estate sector. So let me give you a couple different facts to support that. First of all, their loan to values are less than 35%. That's pretty conservative. They learned some hard lessons during the great financial crisis in 2008 and 2009 and have delevered their balance sheet substantially. 86% of their debt is fixed for a term of around 6 years or so. So that really means that they don't have the refinancing risks like maybe some of the broader commercial real estate market does. And so case in point, our analysis suggests that there will be a modest headwind from rising interest rates and their need to refinance debt, but it's only around 1.4% percentage points per annum hit to earnings. Again, a headwind, but not anything significant by any means. And I think that's my resounding point to you, and maybe it leads into why these transactions are occurring. REITs are on a much stronger footing than a lot of the broader commercial real estate market, and we think they will prove to be winners from this pullback in valuations that we're seeing right now.
And Rich, I'm also interested just internationally, what looks attractive to you in REITs? Is it China? Is it Europe? Or no, would you rather prefer to stay in the US right now?
Yeah, look, I mean, a couple points we would make. We do run a global diversified portfolio across listed REITs. We think there's opportunities across the globe at any points in time. A lot of our focus right now is in the United States because it tends to be a leading indicator. So we've seen listed REITs pull back. We've started to see their valuations stabilize while private valuations are still declining. But I would make the point to you, sort of this lead-lag relationship that we see in the United States with listed leading in downturns and recoveries relative to the private market. It's not unique. We see the same exact opportunities beginning to play out in Europe. We just so happen to think that a lot of the opportunities right now are in the United States, but those next opportunities will be coming in Europe.
Rich Hill, thank you so much for joining us today. That was great, Rich.
Thank you for having me.
We've got breaking earnings news from Pinterest, and the shares are surging some 8% after reporting third quarter numbers here. Third quarter revenue coming out at $763 million. That is ahead of what analysts have been anticipating, and it's a gain of 11% year over year for Pinterest here. As you can see, adjusted earnings per share also beating estimates. And the company said third quarter monthly active users rising to 482 million. That also is ahead of what analysts had been estimating here. Just looking at the press release here, Bill Reddy, the CEO, talking about accelerating the business. The global growth in monthly active users was robust and substantial margin expansion as well. You know, Pinterest has had kind of a volatile time over the past year or so. So interesting here to see this pop on the numbers.
Yeah, it's interesting. So a couple things. One is obviously on the call, it'll be great to hear what the execs have to say about the ad market. But really, when you step back here, so we had Alphabet and Meta and Snap, and they all reported accelerating ad revenue growth. So I'm interested to see the kind of trends the execs see, not just now, but looking ahead in that market. Also remember, Julie, Meta and Snap on their calls, though, they did pointedly call out geopolitical risk, the Israel-Hamas war specifically. So I'm curious to see whether that comes up on the call as well. And another big one here is going to be that Amazon ad partnership and what kind of tailwinds they are executives seeing in the quarters ahead, too.
You know, it looks like that the company has fallen after the past Q3 earnings report. So we'll see if it can hold on to these gains here. We have seen, of course, some situations during this earnings season where the stock pops and then it comes down after the conference call. So to your point, what it has to say about these various issues is going to be quite interesting here. And even though Pinterest is smaller on the social media front than a Meta, it'll still be interesting to hear what it has to say about the broader ad sales environment, which has been a big focus for investors.
For sure.
Let us also talk about VF Corp, which is also just out with these numbers. And let me just cut to the chase here. The company is withdrawing its guidance. That is why you're seeing the shares down about 7% here in the after-hours session. Now, it talks a lot about in the release about Project Reinvent. The company has a new CEO, relatively new CEO, Bracken Darrell, who's talking about his first 100 days at the company and the transformation he is trying to push here. In constant currency, revenue down 4%, revenue down 2%, excluding that effect to about $3 billion. It's pretty much in line with estimates. Adjusted earnings per share just missing by a penny here. But again, the company is withdrawing that forecast. So that is what's going on here. I'm continuing to look in the release here to see exactly what's going on and why they're making this withdrawal.
So VF Corp, obviously, parent company of North Face. Stock has been a total mess, right? The CEO, Bracken Darrell, took the reins over the summer in July. And heading into this print, it's, analysts who cover it were saying, listen, sentiment is very negative. Most analysts heading into this print, like 48%, were at a hold. But the stock has been a real underperformer, and no surprise, that has attracted the activist investors. So specific Legion Partners and Engaged Capital have circled.
Yeah, and it's interesting that they've circled and they're pushing for changes with a relatively new CEO at the helm. Just a few more details here. Even though the company is withdrawing revenue and earnings guidance, it's giving free cash flow guidance, and that's not good. It's cutting that free cash flow guidance to about $600 million compared with $900 million previously. What is it blaming on this? Van's performance, it says, is probably not going to get better in the second half of the year, and they're also pointing to a more difficult U.S. wholesale environment. So those are the two major factors here behind what's going on. We always talk about like how these things touch us. Do you have a lot of North Face and Vans gear?
I have no North Face and Vans gear. No, I'm not anti-North Face or Vans at all. In fact, I welcome it. But no, there's none of that in the Lipton closet right now. I mean, Hanukkah is coming up. I don't know.
You never know. Maybe you're going to get a
generous.
Maybe a pair of skate shoes. You never know. All right, coming up, Anheuser-Busch earnings are on tap, and we're going to break down what to expect, what you need to know ahead of Tuesday's report. That's next. Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
All right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
AB InBev is set to report its latest quarterly results on Tuesday. This coming as the company tries to turn around Bud Light sales following backlash from a partnership earlier this year. Here with what investors should watch out for is Yahoo Finance's very own Brooke DePalma. Brooke.
Good afternoon, Josh. That's right. Many analysts on the street are wondering, have we hit the bottom yet for Anheuser-Busch? And this past quarter being very important, especially given that we're coming up around the time where retailers restock their shelves and choose what they want to fill. But Wall Street is largely expecting a softer third quarter earnings result. Revenue is expected to come in at $15.83 billion, while adjusted earnings per share is expected to come in at 85 cents. Now, volume growth is expected to decline yet again, driven by a decline here in the U.S. It's also worth noting that this quarterly results is being compared to last year when many retailers looked to buy ahead of price increases that took effect in October of 2022. And many analysts are once again expecting that we might have hit a peak impact this past quarter as once again those retailers readjusted. But some positive here. Analysts are expecting improved profit growth as the cost of goods begin to ease the pressure there. In addition to that, many keeping an eye on its Latin America exposure, especially in Brazil, which they said should be fairly resilient. And really what we're largely looking for is any sort of comeback story from this beverage giant.
Brooke, the company also recently announcing a partnership with the UFC.
Yeah, Julie, that's right. The company announcing a partnership with the UFC. One marketing expert that I spoke to said that this is really going to let them drive into a younger demographic that won't necessarily go to other sports. We know that Anheuser-Busch is really trying to double down on its demographic. Who that is, they're really trying to understand. But we have seen them really invest heavily in marketing when it comes to sports. That deal, though, is set to begin on January 1st, 2024. And so while they might mention it on their earnings call, those details I'm sure we'll hear a lot more of in the coming year.
Brooke, thank you so much. Great stuff. And coming up, we're going to go round the horn with today's top stories.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Mr. Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
'23 rocked the markets.
NVIDIA, the stock has been on a tear.
Silicon Valley Bank's collapse is the second largest bank failure in the U.S.
Inflation,
mortgage rates,
The diabetes drug, Ozempic.
Now it's time to make bold decisions. Yahoo Finance Invest, the marquee event for investors seeking big ideas and bold decisions. Guided by the newsroom you trust. Don't miss it, November 7th, exclusively on Yahoo Finance.
Welcome back to Yahoo Finance Live. Josh Schaefer here with Alexandra Canal and Pras Subramanian, breaking down some trending stories that we had our eyes on today. And it's a big week for the labor market. We have the jobs report coming up at the end of the week. We're also going to get some information on the unemployment rate, of course, within that, wages, how much people are making. But Pras, on your beat today, some big news in terms of the auto strike. We see now tentative deals for all 3 of the big 3 automakers with the UAW. And I think as we sort of come out of this summer, both your guys' beats, when we think about also the writer's strike, it sort of was the summer of the strike, some people were calling it, and what that means for the labor market. To me, the biggest takeaway out of just being able to see these strikes happen was workers are still coming from some level of a position of power, right? We've been waiting for this labor market to not be so tight, to loosen up a little bit. And in order for all of these workers to be on strikes, they clearly feel relatively comfortable from a financial standpoint to be able to not make money or at least get funded from the union at the time and feel comfortable in getting funding that way. But I think that was one of the broader takeaways I had from the whole experience, because just, okay, they got to feel at least a little bit confident in the overall labor market to be able to make the leap.
Yeah, well, I mean, there's a lot going on there. First and foremost, I would say that the automakers themselves, most recently in Q3, made a lot of money. So if you're a worker on strike, you're saying to yourself, we're going to hold out and get more. So essentially, Sean Fain came in with huge demands. People thought he was sort of kind of a bit out there in the sense that he was asking for so much. They thought is this guy realistic? Is he a joker? And it turned out he was right. They came to the table. They did this stand-up strike that kind of caught a lot of the automakers off guard. They're able to get to the table, push through some deals, got 25% raises, COLA adjustments. Potentially, what we're hearing is that the battery plants will all be unionized too. That was a big sticking point. So a lot of big concessions there. But anyway, back to what you're saying, the workers feel like this is our chance to press our advantage right now because of all the good times they've had. And the economy's still good, right? Stock market today just rallied again, right? I mean, we had some turbulence recently, but it's all sort of pointing to the area that they need to be where they are right now, and they need to be actually kind of pushing their advantage right now.
Yeah, and I think it's very similar to what we're seeing happening in Hollywood. We saw the end of the writer's strike. They held out for a very long time for that deal. We had the actors' strike still ongoing, but the actors, there's reports out there that this week we could possibly see a deal, and the actors are holding out as well. They saw what happened with the WGA. Similar to your beat, they know these companies have a lot of money, billions of dollars. That being said, though, a lot of these companies are pushing for more growth initiatives like streaming, direct to consumer. The profitability there, it's a problem for virtually every media company except for Netflix. So I do think to your point, that the workers are in a position of strength. They know they need them. They know they need content. They're holding out. We've already seen some of the ramifications of these ongoing strikes play out there with the delay of certain theatrical tentpoles, the live action Snow White from Disney, Paramount's latest Mission Impossible, all pushed into 2025.
Yeah.
That means the box office is going to really suffer in 2024, and that has ripple effect.
And I was going to say the ripple effect there becomes, so when do the workers no longer have the leverage, right? Because part of the slowdown that we're waiting for here, when we think about higher for longer and what that means for companies, would means that it probably hurts your profits, right? And eventually it hurts your profits. So what's one thing you're going to do? You probably cut headcount to some extent, or maybe you create less content. When you think about what it means for the streamers,
which we've seen from
now
Disney.
that once these writers come back, are they not actually going to want all the content that those writers are going to be able to provide because it impacted the companies so much?
One of the issues from the auto standpoint is that the workers have protections for layoffs, right?
Built in once
they
come
have
back.
to be sort of kind of gone through the system, and only in certain situations can they actually lay off a bunch of workers. Now, there was a sort of really extreme example in 2007, 2008 where Black Swan event sort of knocked them out, right? And that's where the unions had to kind of cave into a lot of the demands that the automakers needed to survive. So I'm not expecting that to happen, but you're absolutely right. Like, when does it sort of hit a point where the actual businesses are saying, we have unsustainable labor costs? I don't think we're there yet with the autos. I don't think that's the case right now, but potentially that we're talking about costs. Ford said that at the end of the contract, the UAW workers will be making around at top tier wage $80 an hour, which is compared to 50 to 60 for Tesla right now. Plus the cars would probably be about $850 more to $1,000 more per car based on labor costs at the end of the contract, 4.5 years from now. So can they compete at those price levels, those cost levels is the big question.
Yeah, and I think building in some of those protections for these union workers has been critical. From the Hollywood standpoint, they're really pushing for protections around the role of artificial intelligence. A lot of these companies also have been only putting 1 or 2 writers on a project. For the writers, they really wanted a minimum staffing requirement that you can't just put 2 writers on a project. We need a full team. So where the companies were trying to kind of shortcut and trying to trim down in order to save money, the writers have fought back and said, well, you can't do that. We need these protections. And it's interesting because in Hollywood, these contracts expire every 3 years. What was 3 years ago? 2020. That was COVID. There wasn't any movement on any type of deal because everyone just wanted to keep the lights on. So really, this has been 6 years in the making if we're thinking about how much the industry has changed, especially in media. Now we're kind of having the ramifications of all of that.
And I think when we spin it forward too and talking about sort of what happens next, two of the bigger things that stood out to me is just we never saw massive movements in the labor market from this, and that's in the broad labor market data that we track, right? Like you take a look at the unemployment rate at 3.8%. It moved up slightly at one point because of some of the stuff in Hollywood. People were citing that, but it never got that big. And I think similar with the auto strike too, we've ended up falling in what, Pross, about a 6-week range here, I think, of what?
A little over 6 weeks.
And so a lot of economists had said it would take several months for it to be a massive impact, right?
And it was staggered, right? It wasn't like one whole automaker.
Right, they never had everyone leave.
And chose different plants at 3 different automakers. So it never really was like a huge sort of effect on the auto industry in particular.
The impact on the overall economy, at least for Hollywood, experts told me that it was more than $5 billion, and primarily due to lost wages. So if you think about that, over the 5 months that the writers were on strike, the actors, they've been on strike for around 3 months. So that adds up over time, and it does affect the economy.
And it's been interesting to see, too, how it gets priced into the stocks, right? Specifically looking at those auto stocks over the last 3 months. You take a look at GM, Stellantis, Ford, down pretty significantly, it looked like, at least in the last month or 3 months, and taking recent drops, too. I think that's part of what you were saying about pricing in sort of this added labor cost, right? And how it's going to hurt the companies in the long run. You can see on your screen there, Ford down over 25% over the last 3 months, GM down nearly 30% over the last 3 months.
A lot of that is also they're withdrawing their guidance with concerns about that. But that's sort of cleared up. Also, it's the EV stuff that's the question mark right now. That's another story.
Yeah, and guidance, we know, is very important to investors, especially this quarter. But we'll see what happens with the actors, potentially resolving that strike this week. It's something I'm very focused on. Another thing I'm very focused on, as always, is Kim Kardashian, because her company Skims is now the official underwear partner for the NBA, the WNBA, and U.S. basketball. According to a press release, Skims is going to leverage the power of basketball to generate excitement and demand. It's also going to be featured across a variety of league platforms, so a lot of different touch points there. Kim Kardashian did launch Skims in 2019. She recently expanded to menswear, so the perfect opportunity here. It's valued at $4 billion as of June, and just another way that the devil works hard, but Kris Jenner, her momager manager, works harder.
Okay, I gotta say, the men's sort of talking about undergarments, talking about grooming, we're talking about, I think men's makeup's the next big thing. I really do. I really think that.
You're just saying that because you go on camera every day.
But I never knew it would make such a difference.
That's
I had
true.
no idea.
Yeah.
So I'm saying
that's
I'm
true.
saying men is like the untapped sort of market. I'm reading today that the men's grooming market is supposed to grow to $115 billion by 2028, and right now it's around 80. So we're talking about nearly a double, not a double, but like a 50% growth rate in that. So I think men are the next untapped sort of market for undergarment stuff, slimming, makeup, hair, whatever.
I'm just all in on Skims. I mean, I gotta get some of these. If Skims are that comfy, from the shirts to the I think they look, and we talked about this just with the initial launch too. It just makes sense to partner with athletes, right?
Mm-hmm.
That's a great way to get into the men's market, have players that they know wearing Skims, get Skims all in your face, and then you end up buying them.
I mean, I don't know if you can, but maybe de-emphasize sort of like Skims, like, oh, it's a women's thing. It's like, actually, no, it can be for men too.
I love that we're living in a Barbie world now where we have a female company tapping men as their next frontier. I love this. This kind of feeds into the whole narrative of a girl summer.
I think she's hitting the nail on the head right there. I think it's really smart.
And the partnership with the WNBA too also stands out just as far as Skims, reminding people that Skims is activewear.
Yeah.
Because I think people like it for comfort in the same way that we like a lot of things that sort of become that athleisure wear for comfort. But you're partnering with the WNBA, those women are going to be wearing it, obviously, I would assume, while they're playing. And being able to brand it around that makes a lot of sense. There's a lot of research out there on how connecting with women's basketball players and then women's soccer players, the U.S. women's national team has been so good at marketing. When you can tap into that women's sports market, it is great advertising.
And if you're watching it on the TV, it's there, it's in your face. People that haven't even thought about it, see it, want to try it. I'm very curious how lucrative of an opportunity it is moving forward.
So is Skims also kind of have the Spanx thing where they kind of slim? So they do both
that was
slim
really
and...
what brought them
Right,
to
that's what I thought, right.
was shapewear.
Right.
And now they've expanded to pajamas, shirts, menswear. So, there's more to come on this. And I feel like we could even see more from Kim K moving forward. But that'll do it for us here on Yahoo Finance. We'll be right back on the other side of this break with more market action. Stay tuned.
Amid all the tragedy and upheaval created by the COVID-19 pandemic, we also learned a great deal about the disparities in our economy, perhaps none more so than the disproportionate impact on Black-owned businesses. In the aftermath of 2020, Black business owners began to increase, but the need for structural changes at the federal, state, and local level has not dissipated. So where are we now? Shark Tank star and entrepreneur Damon John has been a trailblazer for some time. His Black Entrepreneurs Day will return for a fourth year on November 1st. My colleagues Rachel Akufo and Akiko Fujita spoke with Damon. Here's what he had to say about disparities in the U.S. economy.
Things are still the same. Actually, they may actually be getting, unfortunately, a little worse because there was a lot of people who had a pent-up frustration, or they felt they weren't doing enough. A lot of the corporate citizens, and now they're pulling back a little bit. They've not totally abandoned, but they felt like, well, let's move on to other what they believe are critical issues. Okay, with that, and with all the interest rates rising, and some of the stuff you were talking about with consumers, they're questioning their position and where they lay their money. However, the same thing is still happening with African American consumers. They're getting the last bite of the apple. They don't have as many resources, and they don't come from legacy wealth, though. It's kind of like playing Monopoly and never getting $200 every time you pass go.
Damon, you mentioned some of the sort of corporate initiatives pulling back 4 years into this. There was some concern on the back of the Supreme Court decision striking down affirmative action that this would kind of give cover for companies to say, look, we can scale back our DEI efforts because race shouldn't necessarily be a factor. I wonder, I know we're talking about entrepreneurs here, but I wonder if you have seen a direct effect there. I mean, what are you hearing from companies who are saying this is maybe not the number one issue for employees anymore?
Yeah, I've heard that they just, listen, it's a big world. You have a lot of issues that people want to be part of, right? You have LGBTQ+, you have veterans, you have handicap, you have a lot of other issues. So it's not that they have a bad intent. However, the studies suggest let's be greedy about it. The studies have shown with the diverse workforce, and if you look and think like the people you serve, that creates innovation, and it's 18% more profitable to the bottom line. Right, so we are not even thinking about purely just from the aspect of is it the right thing to do, but there would be no FUBU if I didn't work with other cultures and manufacturers to create a FUBU, or the industries that we see today. There would be no Sean Puffy Combs, Russell Simmons, Quincy Jones, and various other things. So you even talk about the gender. I believe that. And as you've been seeing, that women and African Americans get probably about 4% of venture capital. But when you look at technology that has broken down the walls, when you look at crowdfunding, we get about 30% of the capital due to breaking down the walls. So I think it's just in the best interest of the business's bottom line. And we're seeing that now, because if you look at the General Chase and Shopify, who've been with me since day one, their numbers have exploded. Lowe's, T-Mobile, and Trine, and we have new members like McDonald's. The first year our first year winner of a grant, Harlem Chocolate Factory, well, she's opening now in JFK International Airport, right? So we're seeing some of these seeds that have been planted 4 years ago, we're seeing them start to blossom, and that's where I want to concentrate more on the positive aspect of it.
And Damon, you raise an interesting point about Black Entrepreneurs Day, not so much about being a cause, but really giving normalcy, giving, the same opportunities that any other entrepreneurs should have. What are your expectations for where things go from here and what you'd like to see from a lot of these companies? I mean, considering how many people are applying for these grants?
Well, a lot of these, most of these people, or most of these organizations that I work with, JP Morgan Chase and the General and T-Mobile, they already have resources set aside. And that's the beautiful thing about this. Whether you win the $25,000 grant, and we have various amount of grants being given away, the resources are there. So you don't have to win something. You can go in and find things in one place. When you look at JP Morgan Chase, they have banks and bankers in the community. But me, even growing up, I didn't look at a bank as someplace that I belonged. I went to a check cashing place right next door. I paid 6% when the banker was literally in the bank so they can find a new Damon John before he or she is Damon John. right? And when you have McDonald's trying to get new franchise owners, so it really is breaking the stigma of the African Americans who have been, or the perception where they felt like they did not belong. And there are these organizations and corporate citizens who do want to make a difference. So it's on both sides. Either you have the resource, you're giving it, or the community doesn't trust you because they've been let down so many times. But a company like Nike, they're always on the right side of the debate, and that's why they have this rabid customer.
Our thanks there to Damon John. And coming up, it's closing time here on Yahoo Finance. We recap the top stories of the day and get you set for everything you need to know tomorrow. Stay tuned.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Let's take a look at what's trending after hours. Now, we start with Chegg, the education company, coming out with its earnings and a forecast that perhaps is disappointing some investors here. We see the shares down almost 5% in the after-hours session. Now, revenue fell 4% year over year, but came in basically in line with estimates here. Losses also pretty much, or adjusted earnings per share, pretty much in line with estimates. The company did come out with a forecast that maybe left it some room to miss estimates. Fourth quarter revenue, it says, is going to be $185 to $187 million. Analysts were looking for 186.4, so we're looking for disappointment. Maybe it's there. I'm looking at the commentary as well. There were some prepared remarks ahead of the conference call from Dan Rosensweig, who's the CEO and president, who talked about the company dealing with the challenge of AI. This has been a big narrative for Chegg, and basically saying that they have adapted a lot of AI-powered tools that he says, are seeing success with their users and with students. The shares, though, are still down some 65% year to date. We got negative news today on the semiconductor front from On Semi. Now we have Wolfspeed out with numbers that beat estimates. Those shares up some 9% in after-hours trading. As you can see, the shares are down about 60% year to date here. But if you look at the Wolfspeed numbers, that forecast looks like it is positive here. Adjusted earnings per share from continuing operations positive, 56 to 70 cents. Analysts have been looking for a loss of 68 cents, so that seems to be better than had been predicted. The loss in its fiscal first quarter was also more narrow than had been anticipated. So we're going to keep an eye on that and the ripple effect as well. And then an update on BlackBerry, the company confirming indeed that John Chen is stepping down as CEO. The shares only up a little bit in after-hours trading, but that's because we got the news reported by Canada's Globe and Mail newspaper before the close of trading. So the shares rose 6.5% at that point in time. You can see here the move upward in the shares when that headline broke. And it looks like in the interim here, Richard Lynch is going to take the helm of the company as interim CEO. They're looking for a permanent CEO as the company undergoes a transformation, spinning out its Internet of Things business and trying to sell its software portfolio. Josh?
It's closing time here at Yahoo Finance. Here's a look at some of the top stories of the day. The cross-examination of Sam Bankman-Fried is now underway. Prosecutors are grilling SBF as they look to frame his public statements about the company as misleading or lies. At one point, he said he called some of the shots at FTX, but he also kept many of his answers vague or simply said, "I don't recall." And just about a year ago, Elon Musk took Twitter private for $44 billion, but reports now say the company is valued at less than half that, at $19 billion. According to The Verge, internal documents show employees at X were awarded equity in the company at a valuation of $19 billion or $45 per share. That price is a 55% discount to Musk's original purchase price. And separately, Fidelity marked down the value of its X shares by another 8% in September. Fidelity, remember, put up $300 million in Musk's takeover. So in that time, its shares are down 65%. And McDonald's is raising prices in California. The company's CEO making that announcement on its earnings call, saying the price hikes will offset higher labor costs. Starting in April, fast food workers in California will start making at least $20 an hour.
And it's time now for What to Watch on Tuesday. On the earnings front, Stellantis among the names to report its quarterly results. This coming shortly after the UAW announced a tentative labor agreement with the automaker. Meanwhile, AB InBev also slated to release its numbers. Sales for the company's Bud Light brand will be a point to watch after taking a hit, of course, from backlash earlier this year. And on the economic front, a new print will be released for the S&P Case-Shiller Home Price Index. That report out 9 a.m. Eastern Time. It'll detail the latest home price data for August. Also on Tuesday morning, a new reading for consumer confidence is out. The data for the month of October coming after confidence fell again in September. And that'll do it for today's Yahoo Finance Live. We'll be here tomorrow at 3 p.m. to bring you all of those anticipated events and more.